Hi, I'm Mike Gelb, and this is Consumer VC, where we discuss what it takes to invest in and build scalable consumer businesses. If you're liking this show, please subscribe on whichever channel that you're listening to this show on, whether that's YouTube, Spotify, Apple, and check out the newsletter at theconsumervc.com. In the newsletter, you'll get a weekly roundup that covers all the latest fundraisers and launches in consumer, and you'll be the first to know when a new episode drops. So subscribe to the newsletter at theconsumervc.com. This episode was a little bit unique. This is a live podcast episode from Chicago that I did at the P33 Tech Chicago Capital Summit. And P33, thank you so much for the invitation and for everything. It was really just incredible to be at the event and at the summit. I had the most wonderful time. Met some great people. And I chatted with Ezra Galston, who is the founder of Starting Line. Starting Line is a seed stage venture firm based in Chicago and has backed breakout brands like Cameo, M1 Finance, Made in Cookware, and one of Chicago's hottest new fintechs, Attain. Now, Ezra's been on the podcast before. He's been on the show back in 2020. So, as you can imagine, quite a few things have changed since 2020. So, it was incredible going to Ezra's hometown of Chicago and interviewing him or chatting with him on the stage. And Ezra, this was amazing. Ezra was awesome. We talked a bit about Chicago, what the startup atmosphere is like there. We talked about AI, we talked about valuations, what he's looking at when it comes to consumer. But before we get started, I wanted to tell you a little bit about our sponsor, Glimpse. Glimpse, thanks again for sponsoring this episode. Glimpse is an AI-powered end-to-end deductions management service that's focused on recovering revenue from KeHE, UNFI, Amazon, and Target for consumer brands. So what they do is that they centralize deductions with backups. They fully handle disputing on your behalf, the brand's behalf, and streamline the accounting process. So check out Glimpse. The link is in the show notes. Without further ado, here's Ezra. Thanks, P33, so much for having me and for having us. I am so excited to have a chat, to have an interview with Ezra Galston, who is the founder of Starting Line, which is a VC fund right here in Chicago that we'll definitely talk more about. Ezra. Hey, how are you? So I interviewed Ezra. I started this podcast back in 2019, and I'm so grateful to Ezra because he was one of the first people that responded to my cold email when I didn't know anybody in VC.
Nothing's changed. I still have nothing else to do.
And I had him on the show in 2020, which is great. And we're going to have kind of a market update since I think that a couple things happened since 2020. What do you think?
Yeah, it might have been a couple of global events and macro changes.
Yeah, definitely. So for all of you that don't know Starting Line, Starting Line is a seed stage venture fund based in Chicago, obviously, and they backed breakout companies like Cameo, M1 Finance, Made in Cookware, and one of Chicago's hottest new fintechs, Attain. Starting Line's builds a reputation for spotting consumer-first founders early, and Ezra's been a big part of shaping how the Midwest fits into the national conversation. Ezra, thanks for all you do for Chicago. Before we start with the hard-hitting questions, I have to ask, as a pop punk and emo fan, there's a band, I don't know if you've heard of it, they're called The Starting Line. I know that you're also a fan of pop punk and emo, since you have an article called The Quiet Things No One Knows. And you also talked about a little bit on Twitter how there are some VCs that love emo. Was Starting Line named after the band Starting Line?
For legal reasons, I cannot answer that question. No, I'm kidding. I don't know if it was named after. I think I always wanted to name a fund on something that was playful and relatable. First off, I think Starting Line is a great name for an early stage venture capital fund. It's like, well, your company is at the starting line-ish. Like,
right.
It probably would have been better for a sports tech fund or something, but Starting Line still works. Yeah, I actually, when I first started, I wanted to do everything differently. So most funds are like, I don't know, Sequoia Fund 1, Sequoia Fund 2, Sequoia Fund 3, Sequoia Fund 4. And I was like, well, that's boring. I should name my funds like really cool things as opposed to just 1, 2, 3, 4. So I was going to do, if any of you are pop punk fans. I wanted to call my first fund A Newfound Glory, because like something amazing's happened. And then like when things got really bad, like if we were like starting to sink in the market, call the next one All Time Low, and like things like that. But my lawyers talked me out of it.
Would you call Fund 3 Mayday Parade?
Yeah, like help, something like that.
Exactly. So I know you first started your venture career at Chicago Ventures. What made you actually start your own VC fund, want to actually raise it and deal with LPs directly? What was kind of the inspiration for actually founding Starting Line?
Cool. First off, I just want to say thank you to P33 for putting on this event and inviting me. I know why you were invited, because this is cool doing like live podcasts. I have absolutely no idea why I was invited. And this is unbelievably unnerving to do this in like a auditorium. But thank you to everybody who made this happen. This is obviously an incredible venue, Spertus Center / Venue 610. It's really a special place. So just thank you to everybody who put in a lot of time and effort. I recently ran one of our first events ever, and I realized how much work it took in, and it gave me a new appreciation for everybody here who's behind the scenes putting on events. So founding Starting Line, I mean, look, it was pretty simple. I don't know where people are in their own entrepreneurial journeys and what they're doing in Chicago, but as little as 7 years ago, when I was a wannabe investor, I looked around and I could not find a single person writing checks to founders, to builders in the city of Chicago who was under the age of 45. And I wouldn't call myself an ageist necessarily, except that I do think that many startups are started by very young people who have no idea how hard the world is and don't know yet what they don't know. And that's a blessing and not a curse. It's a feature, not a bug. In many ways. And so I kind of looked around and I just thought that Chicago had a relatability problem. And I'm not sure that I've solved that by any means. In fact, I think that we haven't accomplished the vast majority of what we want to do, though it's still early. But I am thrilled that Chicago now has a lot of really young, diverse, relatable investors, whether that's Samara at Chingwana or Peter and Jackie from my old firm recently spun out and started their own fund, and they're all young and hip and cultural, and I think in the zeitgeist of what's actually really appealing to a younger founder, whether that's somebody in high school or college or in their 30s or whatever it is. But it's a very different vibe than what existed back then. So I think that was a big part of it. But like any founder, I thought that there was a hole in the market and I wanted to build something great. I also thought that at the time, most of the investors in Chicago were very smart. I think they've all made more money than I've ever made, which is something else we can talk about. But I didn't think they cared very much about brand. And ultimately, I think what founders need to optimize for is, am I partnering with a capital provider? Am I partnering with a brand that is strong enough that will attract more money in the future? You know, you can argue what a CEO's job formally is, but at the end of the day, you got to hire great people and you can't run out of money. And so partnering with a brand that represents, that has signal, so to speak, across the globe, is a great way to ensure that you don't run out of money. So that's kind of what I wanted to build. I think we've executed on some, failed on others, but it's a work in progress.
No, thanks so much for that. And also, just to echo your sentiments, thanks for everyone that's producing this event, P33. This has been incredible. And I can't even imagine how much work it's been to actually produce this. So I understand you wanted to focus, or you didn't see any checks written to founders under 45. Why consumer?
Yeah, sorry. Just to be clear, there are plenty of checks being written to people under 45, but the check writers themselves were not. And I think that was kind of that was just sort of the core. I would meet 21-year-old kids all the time because I was at the time probably 27, 28, and they were just looking for people who felt more like them. And a lot of them were going to San Francisco because the check writers in San Francisco were 25. And it was just a lot more relatable. Why consumer? So my background is in consumer. I ran marketing. I had a couple of companies with a few of my friends in the gaming industry, in the poker industry, and then in daily fantasy sports. And I helped run marketing for all of them. And I loved marketing. And when I started making investments at a broader platform, Chicago Ventures was a generalist platform. I very much just biased towards the consumer side of the house. I just thought it was more interesting. I thought that selling enterprise software to big enterprises was one of the most boring actions that could exist on earth. And you're here. Okay. I totally understand. I mean, there's a lot of money in it. And certainly if you've worked at a big company and you spot all the inefficiencies in a big company, it is very appealing to go in and solve some of those problems. I've never worked at a big company, so I'd have no credibility selling software into a large enterprise. I think that was number one. Number two is the data was actually super interesting. We are not exclusively Chicago focused. I look forward to talking more about Chicago. I think Chicago is very special in many ways, but the data was actually pretty demonstrative that the main narrative, the main talking points, of most Chicago investors was not actually represented by the data. So let me give you an example. What most Chicago investors would talk about is how so much of the Fortune 500, Fortune 100, whatever, it was in their backyard. I would sit in our fundraising pitches and talks to LPs and, whatever, different people in the ecosystem. I was like, well, there's a third or 40% of the Fortune 500 is in the Midwest and it's very accessible and blah, blah, blah. I think that's all true, but the data is that something like 60%, when I founded Starting Line in mid 2018, 60% of all the realized dollars from broad Midwestern exits had been in consumer-based companies. Now, there are some big outliers, Groupon, Grubhub, things like that, but it was something like 60%, 55%, and yet the only narrative talking point was the Fortune 500s nearby. And guess what? The Fortune 500 hadn't acquired either of those businesses or most of the consumer businesses.
Wow.
So I just thought that there was a hole in the market. Again, we're not exclusively Chicago focused, but my assumption, which has been borne out, and we can talk through some kind of performance, is that there were a lot of people who felt like me and thought like me and had absolutely no one to talk to. Wanted to be that.
Got it. No, that is really helpful. Just to focus first on Chicago, how do you rate this ecosystem, or how do you think about this ecosystem today?
Hi. This is the reason why I didn't expect to be invited here and why I know I'll never be invited back. I think, so here, I think Chicago is in an interesting spot. I think, look, you probably have the data more than I do. I think it's like the third or fourth biggest city in America and like the ninth or 12th most popular ecosystem by dollars deployed and realizations and things like that. What I tell our own investors is that on average, I have sourced something like 1.25 extraordinary businesses, like real fund drivers per year in Chicago. 1.25. We make somewhere between 7 to 10 investments a year. We don't only make 1.25 in Chicago. We make probably 4 a year in Chicago. Maybe that depends on the year. But 1.25 of those have been really good, have ended up being really, really good businesses. And more in terms of like actually being able to return our fund. And so I think that's enough to build a fund, but it is not a ton. It's not like we're drowning in surplus. So the way that I think about things is that I think that there is an enormous amount of potential, but something that I have been championing. Can you help me? Championing. And where people don't really like my approach because I think it's an uncomfortable truth, is that there is a lot of mediocrity. Now, just to be clear, I don't think that the people are mediocre in any way, but I think that many of the people, many of the super high potential, high slope people end up learning from leaders who are not the best in the world. And so I think, by the way, I think we have a global challenge with leadership, and I think we only have to look at many of our own city, country, global leaders to believe that we have a struggle with leadership in our world. But I think on a more micro basis, we have a lot of really talented people who are learning from B+ or A- leaders. Whereas in San Francisco, they're learning from A+ leaders, A++ leaders. We can argue at the margin, whatever. And so something that I have long fought for is to try to up level and be very explicit with people of, hey, I think you're extraordinary, but I think that there needs to be more pedigree built, meaning like, I think what you're building could be exceptional, but you need to surround yourself with other people who are really exceptional, and I don't think you're going to find them here. Not that there aren't amazing people here, but the quantum and density of talent that you need to truly mentor and grow and actualize extraordinary talent is very hard in a city where there have only been a handful of kind of $1 billion outcomes. Yeah, go ahead, Mike. No, please. So that's my honest answer. My honest answer is it's not an issue of people. I would never impugn anyone's work ethic or their opportunity. I don't believe that at all. However, I think that great people are built, not born. I have my own mentors and my own spiritual leaders, and I talk to my rabbi every week about a whole host of issues. We all need great people in our lives, and it's really ascertaining which of the people that we look up to is truly great versus really good, but isn't going to get you to the highest possible level. So that's something I care a lot about. I think Chicago has an enormous amount of potential, but it's a work in progress. It's a startup like anything else. I actually believe that.
How then do you think Chicago could attract those leaders? And is there policy, for example, that could happen within Chicago that actually might then build more opportunities for people when it comes to starting their own companies or even just, venture scalable companies?
I don't think there's any silver bullet. I just think it's time. So like to give you a couple examples, like it is easy to hate on things like, it is really easy to hate on things like Groupon, that, because it's back in 2010 and who cares anymore and all this stuff. Something that I learned is that company made something like 2 or 3 dozen small acquisitions. So let's call it 25 acquisitions, 2 founders and a handful of employees at each of those companies, 150 people in total. I've invested in several of those people. None of them are still here, but I met them because they came to Chicago through that acquisition. Many of those, 2 of those businesses are now unicorns. Another unicorn that we did at Chicago Ventures that I'm very close to, a company called Sunbit. The CEO of that business was the COO of Enova International. Most people don't know Enova. Enova was the first ever publicly traded digital fintech. I think was worth a couple $2 billion. He was the COO of that business. He's no longer in Chicago, but we met him here. So I think that there have been so many extraordinary people that have come through. I think that they have made an impression and left a lasting impact on a lot of people. For some reason, we just have a retention problem. And I'm not in politics. I really don't care. I'm not smart enough to be able to answer all of these problems. But the amount of extraordinary people who have come through and not stayed is tough. That said, there are amazing people here, and it's really all about getting the flywheel going. We have some amazing angel investors, and we have some amazing leaders, but it's just a flywheel issue. It's just time. Like I think the programs are great, and there's something in town called the Illinois Growth and Innovation Fund, which I think is unbelievable. I don't know how big it is, $750 million, $1 billion, and it has spurred an enormous amount of local investment. We actually focus more on how many dollars we're deploying in Chicago because we have to report to them. We have a side letter. We have to tell them how much we invest in Chicago, or Illinois. And we actually pay attention to it now. And that has put a ton of money to work and helped get a lot of younger investors into business. And again, like it'll all pay off. It just takes time.
No, that makes sense.
That's my opinion.
Well, yeah. Well, what does then, let's say it's 5 years from now, 2030, or maybe even 10 years from now, what does a breakout moment for you look like in Chicago when you think that maybe the cards have flipped a little bit?
Yeah, I don't know. I think just looking at things from a first principles perspective is no different than any other startup flywheel. You need great people with capital, and that stimulates risk on. I had for a while, back when money was flowing like growing on trees during COVID, I worked really hard to put together something like $100 million fund. Not for me. I didn't want to manage it. I wanted it to be managed by product managers at a handful of companies around Chicago to basically whisper to all their friends, and have their friends tell their friends, whether you're a product manager, a designer, an engineer, that if you want to leave your job and start something, there's a $500,000 check waiting for you. And I worked really hard to get that off the ground. There was interest. It never, some other things got started instead of that. It never really got going. But I think like anything else, how did you describe it? What was your exact question? What was the phrase you used?
Moment of success.
Yeah. I mean, I think it would just be like a flywheel that sort of spins itself where we're not asking these questions.
Yeah, that's fair. I wanted to also zoom out a little bit on Chicago as well. I know you're on Fund 3, right, with Starting Lines? And when I'm sure you have many learnings over that Fund 3 when it comes to even like portfolio construction or even just fundraising. What do you? I'm sure you talk to a handful and are probably a mentor to a lot of emerging managers. When someone launches their own fund, even fundraise, or even they've already fundraised and are looking to deploy, what do they get wrong, or what's hard about how they think about portfolio construction that you learned?
Yeah, I mean, look. So I think the first thing I would say, given as a nice segue from Chicago, is that our Chicago performance, which again is only about maybe a third of what we do, a quarter to a third, is better than every other market or category that we invest in. I published recently, I don't know, maybe 6 months ago, that I looked at all of our Chicago we've only been in business for 6.5 years. I looked at all of our Chicago investments that were older than I think 3 years, and on the aggregate is a 4x of our invested capital. Wow. And that's after only a few years, which, by the way, if we could do that consistently over a century, I mean, would be extraordinary performance. 4x in venture, I mean, it's obviously not the best. There are 200x funds and 25x funds and 10x funds, but a consistent 4x year over year over year, I would never get fired for that, right? And so it's just as like a nice segue, is that, again, is as critical as I'll be, and I think it's constructive criticism, not criticism, is that our performance in Chicago outpaces everywhere else on an aggregate basis. It's better than our performance in LA. It's better than our performance in SF. It's better than our performance in New York. Performance in Chicago is by far and away the best performing investments we make. We just either we don't say yes enough, or people don't ask us enough, or we don't source enough. But our performance in Chicago has been really, really good.
Well, if that's the case, then like, why don't you double down then on Chicago?
We're trying to, but again, we have a pretty specific mandate, and we find other things appealing as well. You know, it's like, anyway, I think the answer, for what it's worth, is that we can triangulate data around the people better than we can anywhere else. And I think that we have made a bunch of mistakes in people that we thought were really special, but who we just didn't know as well. And something that's really helpful about being in a city as small as Chicago, it may be big on an aggregate basis, but you know, the amount of people who are here, and then, you know, kind of in the broader kind of technology ecosystem in Chicago, has got to be in the tens of thousands at most. And so to get really credible references and an understanding of people is, you know, you'll know other people who went to high school with someone, and people went to college, and family, friends, and you can just get a much deeper, richer profile. And I think that's helped us avoid a lot of bad decisions, and to the contrary, make really, really good decisions on people who maybe we didn't understand their product well enough or their category well enough, but we were able to understand them as a person well enough to say yes. That's my hunch. Maybe I'm wrong. There could be other reasons. Could be that there's not enough capital locally, so we get a better deal. I really don't believe in any of that stuff. I just think it's people. In terms of mistakes, I actually don't know. I don't think that there's like any one size fits all to venture capital. I think one of the beauties, my wife and I were talking last weekend about like she's a therapist. Maybe we'll talk about this later. She's a therapist. We're talking about AI replacing her job. And she was like, well, when's AI going to replace your job? And I was like, AI is never going to replace my job. And that's obviously wrong. But one of the beauties about venture capital is it's really an art form. There's so many ways to make money. There's so many ways to support builders and founders. For those of you who are like, spend time on Twitter or X, nay Twitter, which is a controversial decision. There's been some amazing discussions around Y Combinator and how they make 300 investments a year, and yet nevertheless, it's the best performing early stage investment fund in history, which totally defies the logic of you got to be concentrated. I do think that one of the mistakes that it's really easy to make as kind of a younger fund manager, and I've said this to a bunch of my friends who have spun out, and for what it's worth, almost everyone has raised more money than us. Like, we're super small, but I think the lessons are credible. And that lesson is that it's really easy to hit like your first few zeros and start to get a little scared. And one of the things that went really well for me when I spun out and founded Starting Line is that our first business was a hit and our second business was also a hit. Of our first 5 businesses that we invested in, 4 of them were valued at 9 figures within like 2 years. And so it was like that just created a flywheel of confidence that allowed us to take on more and more and more risk. So a lot of things that we may have said no to if we were kind of scared money, we ended up saying yes to. And so I think the biggest feedback that I give my friends who spin out and want to raise some capital and put it to work is like, it's you got to do everything you can to stay in a positive mindset, to stay risk on.
Well, I know your first fund was a $17 million fund, Fund 1. I know that you've grown since then in terms of
still super small, but sure.
But how has that changed at all in terms of your approach to how many companies, for example, you invest in per fund, check size, all that kind of deal, even like types of companies through the years, or not really?
Not really. I've written a lot about the inversion of the risk spectrum in venture capital. And so what I mean by that is, like if you go back, I don't know, 15 years, it used to be that you would start a company and the only people dumb enough to give you money were friends and family, these things called angel investors. And that's where the first tens of thousands, hundreds of thousands, in some cases, millions of dollars, came from. And what has been fascinating, and that's how it was when I entered venture capital. My first internship was in 2012. I took a full-time job at venture capital in 2013. And that's just kind of how the world was, is we would look at businesses. They would have raised $250,000 to $1 million from friends and family, whatever that means, and from angel investors, whatever that means. And then we'd come in with like the checkbook, and there's the investment committee, and it's like, prove that you deserve to exist. And okay, here's $1 million check. So that doesn't really happen anymore. So I've written extensively on the inversion of the risk reward spectrum. So what's happened, which is crazy to think about, is that because there's so much competition to deploy capital in venture, at least there has been over the last decade in the venture world, is that angel investors have like almost gotten cut out of the first investment round. But because if you're an angel investor and theoretically you've had some success somewhere in your life, maybe you inherited the money, but other than that, in theory, you were an executive or an entrepreneur and you did well. Now you're being invited in later once the company is already de-risked, because you add value. You can help open up new customers. You can provide mentorship. And so founders want you on their cap table and also maybe you have a cool brand and you have a Twitter following or a LinkedIn following. And so like all of these angel investors are no longer taking the inception stage risk. They're getting invited in later when things have actually been de-risked by the idiots like us. And so what that has forced us to do is to rethink really just how many investments we make, and to recognize that we are taking on, because so much of the game now is tracking really talented people before they leave their jobs, calling them when they're sort of on the verge of leaving their jobs and brainstorming about what they would like to do. And then basically telling them, we'll write you a check if you choose to leave your job, and then writing them a check before anything has ever been built. That's not all of venture capital, but it is a big part of the venture capital world right now. And that means you are taking on more risk than you ever have before. Now that is changing a ton in the last 12 months. One, a lot of builders have wisened up to some of the pitfalls of venture capital. And number two, because of Cursor and Lovable, there are a whole lot of people that can build prototypes in like a weekend or less in their spare time without any funding whatsoever. So one of the things, I mean, this is a separate conversation, but like we've certainly been thinking about how that affects our jobs and what the implications of that are.
Yeah, that's helpful. Do you think on the angel side front about angels coming in later, is that partly also due to the rise of pre-seed as an actual stage or investment stage?
In terms of what angels getting cut out?
Not cut out per se, but more like coming in later at like the seed because they're like adding more value instead of actually being like the first check in.
Yeah, there's a whole institutionalization around
pre-seed.
Around whatever pre-seed means. I mean, we can debate like what these nomenclatures are, but yeah, like if you want to start a business now, there are hundreds of firms out there that at least on their website, we can debate, in actuality, but at least on their website say like, we want to be your first check basically before you've sold anything. So yeah, that is an entire asset class.
So what do you think, going through like your three funds, what do you think you got like right, which did really well? And what do you think has been really tough over these past few years?
So in our first fund, I think what we got right is, well, we got really lucky that the first few investments worked. And that made it a lot easier to take risk, as well as do stupid things. I think the one thing that we've consistently gotten right over the last 6.5 years, and by the way, I have two investment partners and then a fund advisor. I should have introduced, I feel like a jerk for not saying it earlier, but I have an amazing investment partner named Haley, who has been with the fund for like 5 years, and she was early at Trunk Club and through their Nordstrom acquisition. I actually met her trying to recruit her to run data analytics, one of our portfolio companies. And it turns out she's good at sales because she sold me on joining Starting Line. And that was that. I have another partner named Scott Holloway, who was the 10th employee at Instacart. And then he got poached over to a company called Flexport to build their Chicago office, hired 250 people there. And we have a fund advisor named Matt Maloney, who founded Grubhub as CEO, took it public, sold it to Just Eat. And works with a lot of our entrepreneurs. But so some of the things that going back to your question, that we got right, we got really lucky at the beginning. That allows us to take a lot of risk. One of the things we've consistently done well is that we have never cared what other people are doing. The question I hate most, and sometimes you need to ask it for diligence purposes and a variety of other things, is who else is investing. I think it's an important question in a lot of ways, but it certainly, I think it is the single biggest bias in investing is groupthink. Who else is investing? So some of the things that we did in our first fund, I would not do again. I think that they are nice investments. Now that I understand the market better, I would not do them again. But I'm thrilled that we said yes when no one else would, because it at least shows that we were really consistent in our original thinking. Some of the things that we got wrong in the second fund, and for any operators out there, this will probably appeal to you, is things went really, really well at the beginning. And all of a sudden, there was a whole world that opened up to us, people who wanted us or claimed that they wanted us. And meaning other investors who said, hey, I've got a really cool company, you should check it out. Or founders who said, hey, heard you guys are doing really, really well. We'd like you on our cap table. And it was really hard to figure out what was legitimate and what was adverse selection. And something that, again, this was during COVID and a bunch of other things, like I don't think we did a really good job putting a process in place to figure it out. And because the fund was is still doing well, but at the time kind of came out of the gate super hot, there was just a whole bunch of press and momentum around it. And it was really hard to process all of the inbound and all of the noise in a systematic way. And we made a bunch of mistakes because we didn't have processes in place.
Did your diligence process change do you think? Or?
Yeah, but the diligence process during that whole period changed. And that, by the way, was another mistake. Now,
and is that because just things were moving just so fast so you couldn't really...
So fast. We never compromised on the first principles of diligence. But I don't think we pushed for certain things like founder references. Meaning my favorite thing is to basically just go like as far back on people as possible and like try to find out who they went to high school with and who they actually are as people. We did references. We're credible fiduciaries of people's money. We called prior bosses. Like, we did references. No matter how things fast things moved, we always did the work. But I don't think we had the same creativity in doing the work that we did when things were a bit more calm. And we've learned from that. And now I think now we don't do the rote work. We don't make the same, even if things are protracted, we're not making the same calls. We are being creative in who we try to figure out who to reach out to. Yeah, go ahead.
No, I was just going to say, you just comment on it, because the last time we spoke was 2020. And I remember off air after we recorded the episode, I said, how are things? And you said, things are just fast, moving so freaking fast. And like, you were just telling me about like the rate of speed that things were happening, which I'd imagine that's probably around Fund 2 maybe era. So just wanted to comment on that.
Yeah, I think, so for our third fund, I very intentionally tried to be a lot more in the shadows. When I was younger, I sort of liked press and I liked being loud and obnoxious. I'm shocked that I was invited here because I've been very loud and obnoxious in the past. But have very intentionally tried to quiet down and be a lot more under the radar, because I think ultimately, yes, I mean, investing is a sales game and people need to know about you and respect you. But I think between the people that the team that we've built at Starting Line, as well as the investments that we've made, anybody who wants to research us and do a little bit of work on who we are will come away very impressed. And I think that one of the most important aspects of investing is actually being able to think. There was a period of time, I mean, Tiger Global ran this playbook where it was just like, we want to sell. The 100 best companies in the world are all very knowable because their revenues are reported and we just need to go get an allocation in each of them. But I mean, that probably works for the 100 biggest companies in the world, but for everybody else, like, thinking is really important. If you're a CEO, our founder, like, thinking is really important. You need time to actually be able to strategize and make good decisions. And in a world where you are exclusively reactive, that is impossible. So the new Starting Line, quote unquote, which is a lot more under the radar, I call us kind of tight aggressive, in homage to my poker days, which is really just choosing your spots really smartly and correctly. That's very intentional, so that we have more time to think and make great decisions as opposed to be reactive to the thousands of things the market is throwing at us. I think, by the way, that pisses off a lot of founders where we take a lot fewer meetings than we used to, again, because we're just trying to be really protective of our time and our ability to think. It means we're not as open and welcoming as we used to, but everyone is human. We all need boundaries. I've gotten cursed out by investors, and I was recently on a date night. I texted back like, so sorry, like, really understand you feel this way. Understand the situation is difficult. I'm on a date with my wife. I'll call you tomorrow. Like, the investor was not happy about that. But like, boundaries are important, Boundaries are important.
Totally. I'm glad you brought up Tiger, and as well as maybe just mega funds in general. Because I mean, when we spoke about seed just now, we talked a little bit about how maybe venture, the pre-seed, for example, is becoming institutionalized, or it actually is like a real stage now in venture. But of course, seed is getting kind of quote unquote attacked maybe from other areas too, with mega funds are kind of coming into seed as well. What's your take in terms of mega funds coming down? I imagine it's just seed is kind of more competitive than ever, but what's kind of the current state of seed from that standpoint?
Yeah, look, I mean, like all things in the investment world, there's kind of a bifurcation of the haves and the have-nots. So the haves have an enormous amount of inbound velocity in demand from the multi-stage funds. The have-nots have to work a lot harder. One of the things about Starting Line that I love about Starting Line is we do both. We've invested in a lot of haves and we've invested in a lot of have-nots, and that's great. That said, a big part of the game is trying to be involved in the people with the highest pedigrees. It's a great way to build a brand. Those people tend to be great recruiters. They tend to be great magnets for future capital financings. And yes, that game is a lot harder. We hosted an event yesterday called Founder Shy. So we had like a lot of we had 5 recent companies that have recently raised anywhere between $5 and $20 million seed stage here in Chicago. And 3 of them had term sheets before they quit their jobs.
Whoa.
Or, functionally, whatever, before they even really had an idea. And those were basically all from multi-stage funds. And we can debate exactly how you define multi-stage, but call it, one was a true multi-stage, or I guess one was a true multi-stage, one was kind of a $600 million fund that claims it's early stage, and one was a $250 million fund that claims it's early stage, but they all basically had term sheets before they quit their jobs, 3 out of the 5. And so, that certainly complicates things for the entire seed ecosystem. I think what it forces us to do is invest in relationships a lot more, figure out at all times the 100 people we want to be building relationships with, that we think are founder curious, that, we believe could build iconic companies if they are willing to take on the risk. Something that I believe in, given that I have 4 children myself, is to never paint too rosy of a picture of building a company. I've never said to someone like, hey, I really think you should do this, if I didn't believe it was the right idea for them. I think you've got to be brutally honest with people. Here are the risks, here are the consequences, all that kind of stuff. But yes, it forces us. I would say that there are probably, at any time, I've probably got a roster of 25 to 50 people that I am talking with every 6 to 10 weeks, how their jobs are going, what they're thinking of for the next few, the next few months, the trends they think are interesting in the world. Scott and Haley have theirs of 25 and 50. You add it up and it's probably 100 people at all times that we're involved with. But the multi-stage funds can do that across 1,000 or 2,000 or 3,000 people. And that's what makes them so powerful.
So how do you stay competitive, and how do you think about the starting line product at seed? Since you obviously have the multi-stage funds kind of coming in, maybe you might be able to pay higher prices, right? And as well, higher valuations, and as well as move a lot more quickly, because it maybe is a bit more of an option bet per se. How do you think about staying competitive yourself?
Yeah, we have not had a ton of success convincing founders to walk away from a $5 to $7 million no diligence check. It's just the reality. There have maybe been, look, there are certainly cases where someone said, I've been offered a pretty a pretty big check, and I don't think it's the right thing for the company, and going to raise less and blah, blah, blah. But it's by no means the norm. I don't think this is the best LP answer, but I think it's knowing what our product is and what we're good at. Our product is people. What we care deeply about are entrepreneurs. Anyone we invest in is not an option bet. There is, I think, no one more obsessive about any investment portfolio on earth than Haley Zollo. And there is no one more anxious about any portfolio on earth than Scott Holloway, my 2 investment partners. And between the 2 of them, we talk to the entrepreneurs that we've written checks to, at worst, every 72 hours. And at best, normally far more frequently than that. Obviously, people don't want us, they're moving too quickly, all those things, but we are constantly caring. I think our product is, I don't think our product is capital. We're way too small for that. I think our product is brand, meaning I think many of the best investors in San Francisco and New York and whatever, know who we are and think we have pretty good decision-making faculties. So I think our product is brand. I think our product is empathy, that we are always going to treat people well. We are never going to screw people over. We have made some non-economic decisions because we made commitments to founders and we decided to stick by them. I think that can be, I think maybe some LPs don't want to hear that, but I think the LPs we have in our fund trust us to make good long-term decisions and expect to be with us over many funds, where any decision we make in the short term to the benefit of a founder, potentially at the expense of returns, will be more than paid off for over time. Whatever those are, it's impossible to quantify that calculation in real time. But again, our product is people, empathy, obsessiveness. it's not capital because I don't think capital is a commodity, and we're not big enough to fight on capital anyway.
How do you approach sourcing and maybe trying to find companies that are, I know it's a cliche, but diamonds in the rough per se, that may be underappreciated or even unknown from maybe other VCs?
Yeah. So first off, like, this is the Consumer VC podcast. Congratulations on building a great platform in the last 4 years. So the truth is that the investment world has been dominated by SaaS for the better part of a decade. And so, in general, I think that our job sourcing, but let's just be clear, we by no means see 100% of the opportunities that are out there. But I think that in general, sourcing in consumer has been easier, because the vast majority of the products that really
are SaaS,
and that really weird people want to build that don't really make a lot of sense. Like, there aren't a whole lot of people who even talk to you about those products because A, they're not SaaS, and B, they don't really make a whole lot of sense.
So the category is underappreciated, and that's part of it.
It has been. What's changing now is because there's this thing called Gen AI, and everyone's like, Gen AI is a new platform shift, and every time there's a platform shift, many trillion-dollar consumer businesses are built. So there's obviously going to be a bunch of new trillion-dollar consumer businesses built, like the next Facebook and the next Google and all these things. So we got to get in front of it. So there's been a huge shift in the last 9 months towards, like, consumer is back. I assume you've seen that. I assume you've had more inbound of guests wanting to sell their wares on the podcast and make sure that they're known and things like that. So I'm not saying sourcing is ever hard, but again, like, sourcing for us is about people in terms of finding diamonds in the rough. I think that's really hard and unpredictable to do if you're not a growth equity firm that has hundreds of people hitting the phones. Like, here's how a growth equity firm works. Growth equity firm is really, really good at raising capital. They have investors who basically just want to earn 12% a year or maybe slightly less. And they have a team of 100 people, of basically 100 recent college grads who are cold callers. And those cold callers, and I know this because many of my best friends work at these firms, they're basically taught the following formula. The formula is, your job is to invest in great businesses where the owner of that business historically hasn't raised a lot of capital and maybe doesn't know how great their business is. But the most important thing is that CEOs are fundamentally lonely. And so what you should do is try to optimize for sort of lonely founders who are getting kind of bored of running their business and want to sell sometime soon, or just want somebody to talk to them, et cetera, et cetera, et cetera. So it is really, it is just an aggressive, like, outbound cold calling machine. And it works. Insight Partner has made an enormous amount of money. Summit Partners has made an enormous amount of money. General Atlantic has made an enormous amount of money. Like, sourcing for quote unquote diamonds in the rough works at that scale. I think we do a lot of outbound, but it is impossible to have that much of a systematized outbound. That said, we use a bunch of tools and AI to look for certain triggers of people if someone's leaving a company, or we have a whole bunch of companies pre-filtered that we think are indicative of the types of people that we might want to back. If somebody leaves one of those companies, we get kind of triggered on that as well. A whole bunch of things that I think make a small difference, but we are by no means a ruthless, growth equity machine. I think, again, we're very people focused. We know the people we care about. We know the people that we think are super high potential, and we want to make sure that whatever they do, we are 100% of the time part of that story.
I'm so glad that you brought up that. That's really helpful. I'm also really glad that you brought up AI, because I know we're going to get to it, and this is maybe a good time to transition over to AI. I recently had Peter Walker, who's head of insights at Carta, who posts, definitely, if you all don't follow him on LinkedIn, he's
great data,
great person to add. We talked last week about if we're in a reset. And because Peter said we should be in a reset, but we're not. And the reason why we're not is because AI ruined it. Do you agree with Peter that we should be in a reset right now, but we're actually not because of AI? And obviously the incredible valuations that are happening with AI. And do you think that there's kind of a bifurcation when it comes to AI valuations versus non-AI tech company valuations?
Yeah, so again, you're talking to like an early stage guy. I'll do the best I can. I don't have the data that Peter has. I think from our perspective, we are definitely not in a reset. So the 9 months between June of 2022, and ChatGPT coming out, which was like March of 23, something like that. Those were like the slowest months I've ever seen in the venture capital industry. Like so many firms were like, yeah, we're on pause. We got to shore up our own portfolios. Like it was the slowest period of time I've ever seen. By the way, that's when we chose to raise our third fund. So great timing. So that is a fact that happened. What is also true is that the AI boom has created a huge inflows of capital into the quote unquote venture capital market in the last 12, 18 months, as people see how quickly Anthropic, OpenAI, Cognition, Merker, Cursor, Windsurf are growing, and they all want a piece of the action. I think yes, like on an aggregate data basis, there is no reset anymore. Like the flows are back. Like if you follow the money is rolling into venture capital. What Peter, I assume, also told you, or maybe if you didn't, we can discuss it, is that almost all of that money is being concentrated in the hands of like 15 people, 15 firms. And those firms almost exclusively focus on later stage investments. And I've spoken to a bunch of those firms, and they think their job is sort of easy. They've never said the word easy to me. But they think their job right now is a lot different than it used to be. They think, it used to be, we got to go out and meet with hundreds of founders and try to market, do market maps and whatever it is. And the job right now is like, there are like 15 companies that are sort of running away with it in the world right now, whether those are OpenAI, Anthropic, the list we just gave.
We
need allocations in all of those because, either they're all going to win or one or two of them are going to win. But if one or two of them win and they look like Google, then we do really well overall. Not all firms feel that way, but a lot of them do. And so is there a reset? I don't even know what the word reset means. And by the way, all markets rebound, like the stock market rebounds. Historically, real estate markets rebound historically, like all markets ultimately rebound. So, I don't think there needed to be a permanent reset in venture capital. A lot of our companies, in fact, I would argue that a lot of our companies did a lot of hard work between June of 2022 and the ensuing 12 months, and actually they'd done the hard work. They'd shored a lot of things up. Their cost bases were a lot better. The thing was growing again. And many of the founders then were a little bit too timid to start to spend money again because they didn't know that there was money out there again. And so that's something that we wrote about it in a bunch of our letters to LPs. And we called a whole bunch of founders and we said to them, by the way, like your business is doing really well. You probably don't understand how well it's doing. And like, you should probably be a lot more aggressive. And I know it's scary to be aggressive because for the last 12 months, you were told that there was no money ever again. And every dollar in your bank account was the last dollar you're ever going to have. Like that is no longer true. That said, again, if 75% of all the money coming to venture capital is going to like 20 people and they're all at a later stage, some of that is flowing down to the early stage, but the vast majority is not. And so I think early stage is still really tough because those growth equity firms, a lot of that money will flow down to people spinning out of, it used to be Meta, but now it's OpenAI and Anthropic, and a whole bunch of other kind of, or Scale, or a whole bunch of other pedigreed AI firms. But that's where they're market mapping. And so that leaves kind of again, there's still a lot of money in early stage venture capital, but certainly not as much as there was in 2018, 19, 20.
How do you evaluate AI companies? Because some of them, of course, are just growing, I think it's like at rates that just are unprecedented. And how do you kind of figure out what, well, first of all, if you should invest in these companies, which I'm sure command pretty high valuations that they're going to pass. But secondly, if that revenue is real or is long lasting versus revenue that might go, they might be a sensation one day and then of course maybe die the next.
Yeah. Look, it's the right question. So I was pretty skeptical on a lot of the froth in the AI market until probably like 6 to 9 months ago.
Okay.
And I told this to our LPs, meaning the investors in our fund, and I admitted that I was wrong. I even wrote a post called "The Internet is Fun Again," which was all about all the cool stuff coming out from generative AI. But the general core of that post, that article, was like, there's a ton of experimentation because the stuff is so novel and interesting, but it's not actually particularly useful. Like having a really cool AI avatar generator of your face or like whatever is like, that's cool and that's fun and you'll pay 99 cents, but like you're probably not going to do it on a monthly or even yearly basis, right? And so in the early days, I thought that there was far more experimentation than there was true 10x product change. My wake-up call was over the last 6 months, and my wake-up call was actually looking at the data for ChatGPT. So if you look at the data for ChatGPT, it is by far the fastest growing consumer application, or really application period in history. But that's not what made it special. If you actually looked at the data of the retention data for all the people who were using it, it looked like basically every other application on earth, which is a whole lot of people use at the beginning, and then 60% of the people stay. And then the next month, 40% of the people stay. And then the next month, 30% of people. And I'm sure you've had a lot of consumer founders on your podcast who talk about the retention cohorts.
Sure.
And it's like 20 to 30% is an amazing retention cohort, and you hope it stabilizes there, but you know they'll ultimately churn, like you're doing the best you can. That is exactly what ChatGPT looked like for the first year, like until through mid to late 2024. And then something happened in the early part of latter part of last year, the early part of this year. Is I just wrote about this in our quarterly letter. It's something called the smile curve, where those cohorts started trending back up, which means that people that had abandoned the product 12 months ago logged back in and started using it every day, every week. And that is really rare. And the reason why it happened is that the product had evolved to the point where it was actually really freaking useful to a lot of people in a lot of use cases. So that was one of my wake up calls of, hey, this is more than a novelty, and this is more than something that people are experimenting with. People are getting an enormous amount of long-term lasting value out of these products. And the more I've researched, the more I've come to accept and capitulate that there is an enormous amount of value being created. I think my skepticism was warranted. Every kind of hype cycle in history has statistically, like the hype has really dramatically outpaced the underlying progress. Like whether it's from railroads to crypto, like the hype always outpaced the progress. But I think in AI, arguably, I think the hype is now underpacing the progress. So to your question, I think the answer is, and I can't speak for other investors. And again, we're a small, dinky little fund. I don't know why I'm here, but we look at everything from a first principles basis, which is to your question on revenue. Like Bill Gurley has a great post from 12 years ago called All Revenue is Not Created Equal, or Not All Revenue is Created Equal. And it's all about actually looking at the first principles of the revenue and who the buyers are and what the consistency is. And so we try to apply that to AI. I think that we use the same first principles looking at all the businesses now, and there are admittedly a lot more unknowns, but the pace of growth, like more than makes up for it. So I'll give you three, how about tangible examples? Is that a good use of our time?
Yeah.
We made 4 investments last quarter, which is the most we've made in any quarter, maybe ever. And they were all basically AI first or AI enabled. One is a new kind of AI social media company. It is 18 months old. It has something like 1 million monthly active users, and it is profitable. It's profitable.
Wow.
It's growing really fast and it's profitable. It's a small team. I think it's like 4 or 6 people, maybe 8 people. But it's just profitable and it's growing really fast, and they can keep up with it because so much of their product is built on AI and a lot of the moderation is AI driven. It's profitable. We just invested in kind of a voice AI SaaS company. It's a B2B2C, whatever. We do that as well. And again, we think it'll be profitable like at the end of this quarter. We invested in a marketplace that is it's a marketplace for large AI companies to source consumer data. It is 11 months old. It will likely do tens of millions, if not more, of revenue this year, and it is profitable. And then we invested in one of the most controversial investments we ever made. We invested in a media company. Called this is the only one that's public, called Every. And Every is like one of the leading AI they call themselves a multimodal media company. A really special team. They are also profitable. So why did they want our money? Well, they wanted our money because they have over 100,000 readers of their newsletter. They have a whole bunch of EIRs that basically want to be affiliated with their brand, and they wanted to start incubating companies, and they needed some capital to actually pay the EIRs to sit around and make great ideas. And while they're profitable, they weren't profitable enough to do that for dozens of people. And so they took some of our money. And that was actually we did a really interesting structure where we told them like, hey, we'll give you up to X, but they only took a piece of the X dollars. They only took a piece of it to begin with because they said, we're an AI company. We're profitable. We don't know how much of your money we're going to need. And we're looking for someone who will basically guarantee us a certain amount of money, but we don't have to take it all at once because we don't know how much dilution we ultimately want to take. And never done that before. Most firms cannot do that, but we're small and nimble and we can do things like that. But again, the commonality is 4 AI companies growing to amazing scale in a short period of time and all profitable. We don't look for profitable businesses. That's not our business model. These are companies that are profitable, not even by their own choosing, just because there's so much interest in what they're building.
Has that changed your mindset in terms of profitability? Just because venture, typically it's growth, not really so much about profitability, but now you have a lot of AI companies that are profitable. How do you think about in terms of like reinvesting those funds and
it has
that sort of thing?
It has a little bit. I don't think we don't seek out profitability. We seek out velocity of demand. Meaning, as consumer investors, the only thing that matters is is this business growing really fast, or can it grow really, really fast if a certain intersection of a few things goes right? What I have changed my mind on is the importance of capital efficiency. One of my soft spots in investing is falling in love with really hard problems that will require hundreds and hundreds and hundreds of millions of dollars. And even when those work, if they don't work well enough, even if we're right, we don't make very much money. My job at the end of the day, as much as we've talked about founders and builders and how much I love them, my job at the end of the day is to make money. And companies that are not capital efficient take a ton of dilution. And there are I chat with my friends all the time. There are a whole bunch of like large and, $1 billion exits that you read about in the press where like the seed investors made like 1.5 to 2x, 3x, 4x on just the dilution will kill you. So I do think that there is a huge benefit to seed investors, given that we have no rights. We can never recap a business. We will never force once we put our money in, like we're basically like, we're friends of the founders and that's about it. We have no rights or control, period. And so capital efficiency becomes really, really important to preserve our ownership in the business. So again, growth matters more, and companies that grow really fast will often take in a lot more money and more dilution. But one of our best performing companies ever, they took probably 25% dilution for their seed round. They realized that things were going really, really well, but they wanted a little extra money. So they took 10% dilution for that. Then things were going really, really well. So they raised a large quantum of capital and took 10% dilution. And then the final one is things were going really, really well. So they raised an even bigger quantum of capital and took 5% dilution. And so our original ownership was 7.1%. Our current ownership is 5.25%. And, that is a home run in venture to only get diluted down by 35% over 3 or 4 rounds of funding. And that can only happen in a capital efficient business where they can kind of call the shots on that.
That's really helpful. You're going to hate this next question. I'm sure I'm going to get a couple eye rolls from you. But, traditionally, I would say the worst, or what some investors say is the worst question to ask in venture when you're talking about the founder is, why wouldn't Facebook just launch this? Or why wouldn't Google just launch this? Or why wouldn't Amazon just launch this? Why wouldn't the incumbents? And what Peter Walker was pointing out last week that I thought was interesting is it seems like the incumbents in AI are quite different in that they're actually coming and like eating other people's lunch, which is quite different in terms of, maybe like the SaaS businesses or the mobile businesses from, call it late 2000s all the way to now. And so how do you think about that in diligence when you're talking to it, when you're meeting a company will OpenAI kind of build this versus like maybe it's doing really, really well right now, but there might be opportunity when it comes to for OpenAI to build it because they still act like a startup.
Yeah, we just learned that lesson the hard way over the last 12 months by making a bunch of AI investments. Some of them are really working well. Some of them are clearly not working. And the commonality of the ones that are working really, really well are an really strong AI native engineering team. Doesn't mean you needed to work at OpenAI, but you better have a whole lot of friends on, or you yourself, on just the frontier of the models and obsessive over the market. I don't think we've made any really fantastic AI investment yet where the engineers and the product leaders behind the business did not have an insane AI pedigree. For a couple of reasons. One, I think to your point, there's just an enormous amount of velocity of competition, both from incumbents and new entrants. And B, for the people who do need capital, all the capital is accruing to pedigree for a variety of reasons. But yeah, those are the mistakes we've made of giving money to people who were not on the frontier of AI models in pedigree.
Got it. That's helpful. I know we don't have too much time. I wanted to touch on liquidity, but before I do, are there any questions from the audience? We want to try to make this as helpful as possible. If anyone does have any questions, I'm happy to keep going. But
what's the name of your podcast?
It's called Consumer VC. Yeah. All right, cool. All right, I'll keep going. I wanted to talk a little bit about, there's been a bit of a liquidity crunch per se when it comes to venture. How are LPs, when you talk to LPs, how are LPs thinking about venture today, especially with stretched timelines, light distributions, probably light distributions as well from like the call it the when the market was peak, in terms of coming now? How do you think about like how you approach exiting businesses per se? Has that changed at all?
What I hear from our LPs is that they don't have a whole lot of money and nobody gives them money. And so that's not a great thing to hear. I think the challenge for us is that the companies that we're most likely to be able to generate distributions from, i.e. through sales or whatever, are probably our best companies right now. And so that's always just a challenge. I'm not particularly, we're close friends with pretty much every founder we've backed. They've all told us, like, if you want to sell shares, you should feel free in the same, like we have permission. But it's been really hard to do so because the only ones where there's an active market for our shares are our best performing companies. And we're romantic optimists and we always see more upside than at present. So I don't know. The one change that we've made is, as a team, we meet every 6 weeks and we ask ourselves, would all things being equal, would we want to buy more of this company, sit on our holdings, or sell this company, sell some down right now? And what surprised me is for a lot of our best companies, we often answer we'd want to buy more. And so, it is what it is. Again, just to be clear, like, we're not a growth stage firm. We don't have people bidding on all of our positions all day long, but we have a couple and we have not sold much yet.
So you've never felt tempted to actually sell from your best companies?
I felt totally tempted.
Okay.
But we haven't done it.
That's helpful. Thank you. Can we also talk about maybe the future in terms of new capital potentially entering the private markets with 401ks? If we're all allowed to actually use our 401ks to actually invest in private markets, how does that, obviously a lot more capital might go into venture. Do you think a lot more capital will actually go into venture funds directly?
I don't know. You guys are attendees and you all have probably savings accounts. I don't know. I suspect some amount would. I think there are a whole lot of young, ambitious people in the world who play with a lot of products, whether those are CPG products or technology products, and all things being equal, given the opportunity to own a piece of those products, would be very excited to. And so my suspicion is that as it becomes easier to access private markets, there will probably be a healthy flow of funds. It's just impossible to know what it looks like. Like, is it a few digital marketplaces that basically consume all the flow of funds into private market companies from 401ks, or into I have no idea what it looks like. But all things being equal, I would have bet that there are a huge amount of regular people who would love access to SpaceX and to Stripe and to a lot of the great companies that they have heard of, as well as a lot of the smaller companies that they use on a daily basis. We've actually, I understand it's controversial, but we've recommended crowdfunding to a lot of our investments. Again, if you are a consumer business, you have a lot of real human customers that in theory love your product if they keep repurchasing it. And I tend to believe that if it's legal and people are adults and can make their own financial decisions, I'll recognize that there's risk in any early stage investment. I don't know, maybe, keep a cap on how much any single person can put in. But I think crowdfunding is like an amazing opportunity to become closer with your customers and give them a vested interest in telling more people and a whole bunch of things. I don't know if that's a consensus opinion or not. I don't think so. But, we've had probably 3 or 4 companies do out of 50 or whatever, 40, do crowdfunding campaigns at different capacities. And I think that's awesome. Give your customers a piece of the action.
Does that, if a company crowdfunds from the venture perspective and that company then maybe wants to go out and raise a fund, right? Is that a negative signal to you?
I mean, these campaigns tend to be pretty small, like $100,000, $200,000, $300,000. It's not making a huge difference either way. So personally, I don't care. But I think the narrative's got to be right. If it was like we needed a $200,000 bridge and the only idiots who would do that are people who don't understand how bad we're doing, yeah, that's a problem. But if you're raising $2-3 million and you want to give your customers, your users, an opportunity to participate in that, I think that's super cool. I think more companies should do that personally.
Yeah, no, for sure. What's the biggest misconception founders have, you think, about raising from institutional capital today?
That it is a sign of success.
Yeah, that's fair.
I just think when we play a game where the
press releases.
What's that?
The press releases and everything.
We play a game where the timelines are super drawn out. It's super, super difficult to found something. It is super lonely to be a CEO. And there is very little external validation while you're doing a hard thing. And when an investor comes in and says, we love your business and we think you're credible and we're going to give you all this money, for a lot of people it'd be hard to say no to that. In many cases, I think they should say no.
Oh, that's great. That's great. If you were an investor today, what company would you build?
I would not build a company. I would go back to rabbinical school and be a rabbi.
There we go.
Or I'd start a farm.
Or you start a farm. What would you grow?
I would milk animals. I just always had a romantic idea of living on a farm. I have a few friends who have farms, and it is a lot of work and not particularly romantic, but I don't know. I love the idea of just being around wildlife and cattle and knowing the person. There was actually, she joined Cameo for a while. There was this TikTok star who was just super close friends with her ostrich and the animals at her farm, and she talk about their personalities. I don't know. I've just always thought that would be really, really fun. I don't think there is any company I love what I do. I hope to do Starting Line for a long time, and afterwards I'm going to go to rabbinical school and then live on a farm.
There's actually a great Netflix documentary about this couple in LA. They live in downtown Santa Monica, LA, and then they move out. They just buy a farm or buy land in Ventura County and start a farm, and they document all the different challenges and like that. It's really cool.
I assume it's far more miserable than it seems to me, because the grass is literally greener on that other side. But that is my ideal utopian vision.
By 2030, what would it mean for Starting Line to have truly lived up to its potential?
That we are wildly indispensable to a very, very small group of people and wildly irrelevant to a large group of people. By which I mean, the founders that we work with, I want them to love us so much that they tell every single friend, whether you need money or not, you need to meet this group of people and work with them. And that for everybody else, they don't even know or care who we are, because I think that one of the mistakes we've made in the past is trying to put a marketing reach that is way too broad. And all that matters is that you know your customer really, really well. In this case, I think a very small group of founders that are sort of insane and on the frontier of new technologies and want to do really, really weird stuff, and that they trust us to take risk with them and to be alongside them even when things are not going super, super well. So again, I think be wildly indispensable to that group and be just irrelevant to the rest would be a huge success.
Do you, as a fund too, I know that it's...
How do you not end there? What a great soundbite.
What?
I'm joking.
So the, I know Starting Line Consumer Focused Fund, it seems like you also invest in as well as not in some non-consumer companies. How do you think about whether you invest in like a consumer versus like more broadly other business?
So just to be clear, like probably 75% of what we do is like direct B2C.
Okay.
And the rest is like B2B2C in some capacity or another, or it touches a real human or a real worker in a very, very real way. So again, we don't do enterprise software, but there are a lot of times where we'll invest in stuff that makes workers' lives more better. Or in some cases, like companies have pivoted and they look a bit more B2B than they were when we invested. We have a company that's doing really, really well down in Austin called Boom, which is now property management for, software for property managers, but it started as like a consumer rent reporting application. And I was like, okay, that was really, really good. And the technology they built ended up being really relevant to property managers. They went into that as well. But I think the core of what we do, and I actually think Josh Kushner from, is it Josh or Jared? I think John, whatever the investor one is, Josh Kushner from Thrive. Josh said really, really well is that the core of Thrive was built on consumer. And even though they now do everything, they take the same investing approach to every single business. He said this on Invest Like the Best with Patrick O'Shaughnessy, which is there core consumer DNA at the core of this product or not? Because whether it's enterprise software or not, the best products will be built with a true consumer DNA underlying them. And he basically gives credit to the early days of Thrive for creating that philosophy in their heads of that is how they're going to look at every investment. The early days of Thrive was Instagram and whatever was only consumer. Warby Parker, only consumer, and they now take that lens to every investment they make, which is awesome.
No, I love that episode. Also, everyone should subscribe to Invest Like the Best. It's unbelievable. And Consumer VC. But Invest Like the Best is like, Patrick is like the GOAT in my opinion. He's unbelievable. My final question is that I always kind of conclude with this question is, what's one book that's inspired you personally? It's my one curveball. One book that's inspired you personally and one book that's inspired you professionally.
My favorite book is The Little Prince. And that is the book that has inspired me personally in terms of dreaming bigger. Inspired me professionally, probably a book by an author named Tal Ben-Shahar called Happier. And he was very early to the positive psychology movement. In fact, many of you may have seen Scotty Scheffler, who's the best golfer in the world. He just gave this amazing 5-minute clip about all the success he's had in golf. Just doesn't fulfill him, but what does is his
great clip.
And Tal Ben-Shahar, I believe, was like the leading wrestler or boxer or something in Israel. And he worked his entire life to win some event. He won it and he felt amazing. And then he got home and he felt incredibly depressed. And he decided to dedicate the rest of his life to understanding why he felt so depressed when he got home. And what he realized is that the happiness that he felt was not happiness, it was relief. That he actually had no underlying happiness, that he had built up so much stress in his life and anxiety that whatever he felt, what he felt at that moment when he won the big event or match was just relief from the stress, but it wasn't happiness. And when he got home, he realized he had nothing fundamentally important in his life besides this. And it didn't make him happy. And that's why he was so depressed. I think that's a book that I read in business school and I have taken with me ever since then of am I professionally pursuing things that are fulfilling as well as personally pursuing things that are fulfilling, or are they just going after relief, happiness?
Wow. I definitely want to read that book. I don't think we've had anyone that actually brought up that book before. Thank you so much, everyone. Thank you so much. This has been...
Thank you, Mike.
Thank you.
And there you have it. P33, thank you so much for having us at your summit, Tech Chicago Capital Summit. I had a wonderful time and really enjoyed talking with Ezra. Ezra, thanks for taking the time. Really enjoyed our conversation, and I really appreciate you doing this. And Glimpse, thanks so much for sponsoring the episode. Remember, Glimpse is an AI-powered end-to-end deductions management service that's focused on recovering revenue from KeHE, UNFI, Amazon, and Target for consumer brands. Check out Glimpse, links in the show notes. Thanks for listening. I hope this was helpful. Until next time, folks.